Silver didn't just pull back, it snapped. One week it was charging like nothing could stop it. The next, it dropped so hard it forced people to question whether the entire move was real or just another cruel market trick. That kind of move isn't random. It's not just volatility. It is the market doing what it always does after a vertical run. It applies psychological pressure. This was a stress test, not for silver, for participants. Because when price moves fast, people stop thinking in probabilities and start reacting to sensation. Pain, fear, greed, regret. The chart didn't just move, it provoked. And provocation is how markets identify weak positioning. And let's be clear about one thing right away. This is not about calming nerves. This is not about reassuring anyone that everything will be okay. That mindset gets accounts destroyed. This is about identifying exactly where we are and what kind of decision this moment demands. Silver just proved it can move violently higher. That's no longer theoretical. It tagged a level that's been talked about for years. Then it violently reversed, bounced, fell again. Messy, emotional, uncomfortable price action. That alone tells you something important. This is not a neat, orderly bull market designed to reward patience gently. This is the kind that punishes hesitation and overconfidence at the same time. Silver is not gold. Gold moves like a freight ship, slow, heavy, deliberate. Silver is a speedboat in rough water, same ocean, same tide. Completely different experience. If you expected a smooth ride, you misread the vehicle. Now, here's where most people make their first mistake. When silver hit that major level, the crowd split into two camps. One side said, "That's the top, get out." The other side said, "This is nothing, we're going to triple digits and beyond." Those two camps look opposed, but psychologically they're identical. Both are trying to eliminate uncertainty by pretending they know what comes next. They don't. Certainty in markets is a coping mechanism, not an edge. We don't trade stories, we trade structures. So let's separate fact from interpretation. Fact: silver accelerated rapidly, hit a widely watched level, and then mean reverted violently. Fact: late buyers felt immediate pain. Early buyers felt temptation. Fact: the move flushed leverage and tested conviction. Interpretation: this is not the end of a move. It's the market compressing energy. Markets expand, then they compress. Expansion grabs attention, compression builds force. Think of price like a spring. When it stretches too far, it snaps back. When it tightens, it stores energy. Compression doesn't tell you direction. It tells you magnitude. When that energy releases, it's rarely subtle. That's why this phase matters more than the headline high. This is where positioning gets rebuilt. This is where people reveal whether they're operating from logic or from emotion. And here's the key mistake to avoid: assuming silver trades independently. It doesn't. Silver does not lead, silver amplifies. Gold is the engine, silver is the turbo. If gold loses its bid, silver doesn't heroically keep running. If gold continues to attract capital, silver doesn't politely wait its turn. It tries to outrun it. That relationship is non-negotiable. So when we talk about silver's future, we don't start with silver, we start with gold. Gold isn't being accumulated because people are bored. It's being accumulated because trust is thinning. Political alignment is fragmenting. Reserve strategies are shifting. This isn't about CPI prints or monthly data surprises. This is about long-cycle stress, the kind that pushes institutions and governments toward assets that don't rely on anyone else, our YS promise. Gold is not just a trade. It's insurance with no counterparty. When gold strengthens in that context, silver doesn't stay quiet. It exaggerates the move. That yes, why selling silver purely because it SI up a lot is lazy thinking. At the same time, blindly holding without rules is how profits turn into psychological torture. And this is where most people get trapped. A big gain feels like skill, even when it's partly luck. And once that gain exists, the fear shifts. It is no longer fear of loss. It is fear of giving back what you already have. That's where discipline gets distorted into stubbornness. So here's a brutal test that cuts through all the nonsense. If you woke up tomorrow and your position was accidentally liquidated at current prices, would you buy it back immediately? If the answer is no, then holding right now isn't conviction, it's inertia. If the answer is yes, then you're choosing the risk consciously. That single question exposes whether you're managing a position or being managed by it. And this is only the beginning of the framework. Because once emotion is identified, structure can be rebuilt. In the next part, we'll break down what the upside numbers actually mean, why silver's market structure makes extreme moves possible, and where logic eventually gives way to mania. For now, understand this. This was not chaos. This was the market revealing its personality. And silver just showed you exactly what kind of ride you're on. Once price goes vertical, people start throwing numbers around like they're guesses at a party: 100, 120, 200. Say them often enough, and they begin to feel normal. That's how the brain protects itself from scale. But markets don't care how a number feels. They care whether the structure can support it. So instead of asking whether silver can hit a certain price, the better question is whether the market mechanics make that move plausible without requiring mass delusion. Silver is not a large market. That's the starting point most people skip. Compared to gold, silver's float is thin, not in theory, in practice. It doesn't take heroic levels of new demand to move silver. It takes marginal demand colliding with limited availability. That's why silver can go nowhere for months and then reprice violently in weeks. It's not manipulation, it's physics. Here's where people get confused. They hear there's plenty of silver in the world and assume supply will magically cap price. That's a rookie mistake. Total supply is not the same thing as tradable supply. A large amount of silver exists in forms that don T respond to price quickly. Old industrial stock, antiques, long-term holdings, embedded usage. That metal is real, but it's not liquid. Markets don't price what exists. They price what moves. When demand rises and float is thin, price becomes the mechanism that forces release. That's when moves accelerate, not stabilize. That's also why silver doesn't stair-step higher. It lunges, collapses, coils, and lunges again. Now, this is where upside targets need discipline. You can construct a rational pathway to higher levels. You can justify a move to triple digits based on relative valuation, monetary demand, industrial use, and gold's trajectory. You can even imagine a scenario where prices overshoot dramatically. Markets overshoot all the time. But there's a line where logic hands the wheel to narrative. Beyond that line, price is no longer moving because of structure. It's moving because of reflexive belief. That's where risk stops being compensated and starts being emotional. This isn't bearish, it's adult. The goal is not to sell the exact top. That fantasy destroys more capital than bad analysis ever could. The goal is to extract meaningful gains while your thesis is intact and step aside when price becomes dependent on mania rather than mechanics. And this is where many investors fail. They confuse having a large profit with having a plan. Profit without predefined behavior is just unrealized stress. The market doesn't care how long you've held or how proud you feel. It only cares what you'll do next. So let's talk about behavior instead of predictions. If you're holding silver after a massive run, you should already know what invalidates your thesis, how much you're willing to give back, whether you will scale out, hold through volatility, or exit on structural change. If you don't know those things, you're not investing, you're reacting, and reaction is expensive in fast markets. Now zoom out further. Metals don't move in isolation. They move inside a macro environment that is quietly changing shape. We are entering a phase defined by two overlapping forces that most people analyze separately: geopolitics and industrial policy. That separation is artificial. Rising global tension pushes capital toward assets that function outside trust systems. That supports gold. At the same time, governments are committing to massive physical build-outs: infrastructure, defense, energy grids, manufacturing, data centers. That spending doesn't vanish into the air. It pulls on resources. This isn't a theory, it's observable. When capital is deployed into real-world projects, it creates persistent demand for inputs. That doesn't mean immediate runaway inflation, but it does mean prices don't revert to old norms easily. Hard assets stay relevant longer than people expect. And this brings us to the metal most investors ignore until price forces them to care: copper. Copper isn't flashy. It doesn't inspire cult followings, but it is non-negotiable. Everything that moves electricity depends on it. Power transmission, motors, data centers, automation, electrification. None of it works without copper at scale. The AI build-out isn't just code and chips. It's physical. It requires massive energy infrastructure. And energy infrastructure requires metal. You cannot software your way around conductivity. This matters because it reframes the entire AI bubble debate. Even if valuations swing wildly, the physical demand doesn't disappear. Infrastructure gets built, or it doesn't. And if it does, metals feel it. So while people argue about tech stocks, the underlying resource layer tightens quietly. Silver sits in the middle of this web. It's monetary and industrial, defensive and speculative. That dual nature is why it behaves erratically. It responds to fear, growth, liquidity, and hype, sometimes all at once. That's not a bug, that's the asset. Which brings us back to the present moment. Violent moves after vertical runs are where bad habits get exposed. People improvise. They chase confirmation. They confuse information with skill. They let pride masquerade as patience. The market punishes all of that. In the next part, we'll deal with execution. How rational participants manage entries, exits, and risk in an environment that refuses to behave politely. Because analysis without execution is just entertainment. And this market isn't here to entertain you. When markets get violent, the biggest enemy isn't volatility, it's improvisation. That's when people abandon process and start making decisions based on discomfort. And discomfort is exactly what this phase is designed to generate. After a sharp move up and a brutal snapback, the temptation is to do something, buy more, sell everything, wait for confirmation. Ask for opinions. None of those are strategies. They're stress responses. Rational behavior starts with one simple act: defining what would prove you wrong. If your thesis for silver depends on gold maintaining its strategic bid, then gold losing that bid matters more than any silver candle. If financial conditions tighten sharply, liquidity drains, and real assets lose sponsorship, that matters. These are inputs, not predictions. You don't wait for headlines, you watch the structure. Markets rarely announce regime changes cleanly. They leak first. That's why execution must be pre-decided, not emotionally negotiated in real time. The second pillar is position sizing. This is where ego quietly destroys people. If your position is large enough that a normal pullback makes you anxious, the position is too big, not because you're weak, because the market is indifferent to your tolerance. There's no prize for being all in. The all or nothing mindset is how complex systems reduce adults to coin flips. Professionals scale. They adjust exposure without abandoning conviction. They understand that selling a portion is not betrayal, it's risk management. You don't need to be fully invested to be right. You need to be solvent and rational. Now let's talk about timing exits, because this is where fantasy creeps in. Most tops are not single moments, they are processes. Price thrashes. It makes false recoveries. It punishes early sellers and late holders. It tempts you back in after you sell and scares you out after you buy. If your plan depends on catching the exact peak, you don't have a plan. You have a hope. Some participants choose to ride momentum and exit on the way down, accepting that they'll give back a portion of gains in exchange for confirmation. That's a valid approach, if your sizing allows it and your psychology can handle it. Others scale out into strength, also valid. What's not valid is deciding under pressure. The market extracts the highest cost from people who try to invent rules mid-storm. Now widen the lens again. Metals are not the only variables in play. Energy matters. Oil matters. And oil is deceptive. On a long-term inflation-adjusted basis, oil can look underpriced relative to the cost structure of the modern world. Energy demand is rising, not falling. AI, electrification, manufacturing, all of it consumes power. But oil is political. Supply responds to incentives, not fairness. Producers need revenue. Governments intervene. That keeps oil suppressed longer than logic would suggest. That doesn't make oil irrelevant. It makes timing harder, which is why diversification isn't about owning many tickers. It's about owning different drivers. Some assets respond to fear, some to growth, some to electricity, some to conflict. Silver overlaps several of those drivers. That's why it moves the way it does. Understanding that overlap prevents disappointment, silver is not a savings account. It's a hybrid instrument that amplifies macro forces. Treating it like something it's not leads to bad expectations and worse behavior. Now let's address the quiet trap that destroys long-term returns. Information addiction. Watching interviews, reading threads, collecting targets. None of that creates an edge. It creates noise. Markets don't reward how much you know. They reward how consistently you execute. If you can't explain why you own an asset in one sentence, you don't own it, you're renting it. And renters panic when the rent goes up. Ownership requires clarity. Clarity requires simplicity. And simplicity requires humility. You must accept the possibility that you're wrong. Not emotionally, structurally. If you're wrong, where will it show up first? Not in price alone, in correlations breaking, in sponsorship fading, in liquidity tightening. That's what you watch. If those signals appear, you act, not dramatically, not publicly, quietly, because survival is the first objective. Growth is second. Now let's bring it back to silver and this exact moment. Silver has shown its personality. It will surge, it will collapse, it will bait you into overconfidence and punish hesitation. It will reward preparation and destroy improvisation. Holding silver right now should be a conscious decision, not a default one. Ask yourself honestly, are you holding because your thesis is intact, or because selling would force you to admit you were lucky? Luck is acceptable. Pride is expensive. The smart posture here is not blind optimism or reflexive fear. It's conditional commitment. You stay engaged while the structure supports you. You reduce exposure when it doesn't. You don't marry the asset, you partner with it temporarily. And when the narrative shifts from logic to mania, when price action depends more on belief than on structure, that is not the moment to get louder. That's the moment to get disciplined. The market will always offer another trade. It will not offer another account. This cycle is still forming. Real assets are still being repriced. Gold still shows strategic demand. Silver remains the amplifier, but nothing lasts forever. The people who walk away with real gains won't be the loudest. They'll be the ones who planned ahead, sized correctly, and acted without drama when the environment changed. Stay alert, stay measured, and don't let the chart steal your discipline when it tries to steal your attention. At the end of every cycle, the market asks the same question in a different accent. Did you manage risk, or did you manage a narrative? Most people don't lose because they're wrong on direction. They lose because they overstay their welcome. They confuse conviction with loyalty. Markets don't reward loyalty. They reward timing, restraint, and the ability to leave without drama. This is where we clean up the final mental errors that show up near big moves. First, stop treating markets like judges of your intelligence. Price doesn't validate you. Price doesn't insult you. Price is feedback. When you take it personally, you stop learning. When you detach, you adapt. Second, understand that cycles don't end because everyone agrees they should. They end when marginal buyers disappear. That doesn't happen quietly. It happens after excess, after leverage, after certainty becomes fashionable. We are not there yet, but we are closer than we were. That's why posture matters more than prediction. The smart stance here is conditional exposure. You stay involved while the underlying drivers remain intact. You reduce when those drivers weaken. You don't wait for permission from social media, commentators, or price targets scribbled on charts. Those are comfort tools, not decision tools. Now let's address something uncomfortable. Many people don't actually want to make money. They want to be right. They want to tell the story later. They want to say they held through everything. That's ego masquerading as patience. The market charges interest on ego. Being early feels smart. Being late feels painful. But being early and overstaying feels devastating. That's when winners turn into cautionary tales. A professional mindset accepts this truth. No position is permanent. Even the best trades are rentals. You stay as long as the structure pays you. When it doesn't, you leave, quietly. That's why exit rules matter just as much as entry logic. If your exit plan is, I'll know it when I see it, you won't. Stress destroys perception. That's not a character flaw. It's biology. You must decide behavior in advance. Not price levels, behavior. What do you do if momentum fades? What do you do if correlations break? What do you do if liquidity tightens? Those answers should already exist. Now, zoom out one last time. We are moving into a world where hard assets matter again, not because of panic alone, but because of structure. Capital spending, energy demand, geopolitical competition, and technological infrastructure all pull on the same physical constraints. You can't print metals. You can't digitize conductivity. You can't outsource geology. That doesn't mean prices go straight up. It means old assumptions don't snap back easily. Silver sits right in the middle of that shift. That's why it's volatile. That's why it's uncomfortable. That's why it attracts both serious capital and reckless speculation. Your job is to stay on the serious side. That means no FOMO buying after vertical spikes, no panic selling during designed shakeouts, no position so large it controls your mood, no thesis so rigid it ignores new data. Flexibility is not weakness, it's survival. And remember this, the market doesn't need you to participate. It will move with or without you. The only thing you control is how you show up. You show up with rules. You show up with humility. You show up willing to be wrong early instead of ruined late. Silver will continue to test people. It always does. It will overshoot logic, then punish belief, then reward discipline. That cycle repeats because human behavior doesn't change. Only the cast does. If you understand that, you stop chasing excitement and start building outcomes. And that's the real edge. Not calling tops, not predicting numbers, not sounding confident. The edge is staying solvent, staying rational, and staying in position to act when others can't. That's how you get paid across cycles. That's how you survive volatility instead of worshiping it. And that's how you walk away from this market with capital and clarity intact. Stay sharp, stay measured, and don't let the noise steal your process when the price tries to steal your attention.